February 20th, 2026, and I have to be honest with you.
Oh boy, here we go.
No, seriously, if you have been glancing at the headlines this week or even just, doom scrolling for 5 minutes, you probably feel like the world is trying to spin off its axis.
Yeah, it has certainly been a week where the headlines and the hard data seem to be shouting two completely different things at each other.
Exactly. And that is exactly why we are here, to make sense of it. Because, well, look at the board right now.
Mess.
It is. We have a Supreme Court ruling that essentially broke trade policy as we know it. We have a government shutdown that just took a massive bite out of our GDP. And, just for good measure, we have the Strait of Hormuz.
The absolute jugular of the oil world.
Right, flashing red with military threats.
It reads like the opening chapter of a geopolitical thriller, doesn't it?
It really does. But here is the thing that is driving me crazy, and really what we need to solve today. You look at the credit markets, corporate bonds, the actual plumbing of the financial system.
And they are totally fine.
They're essentially asleep at the wheel. They are priced for perfection. So our mission today for this deep dive is to interpret this so-called cross-asset regime.
Right.
We are going to look past how scary the world feels and look at what the data actually says.
And to do that, we are looking at a full market context stack. We have got macro regime snapshots, correlation matrices, which, by the way, are acting very strangely right now.
Extremely strangely.
And a deep search of the news events. Supreme Court rulings, GDP prints, all of it. We need to figure out why these signals are diverging so aggressively.
And we represent you, the listener, here. So we are going to uncover why investors are currently paying record premiums for insurance. Volatility protection.
Even though the actual market turbulence is historically low.
Right. It is a total paradox, and we are going to unpack it. Let's start with the winners and losers.
Macro snapshot.
Yeah. Because if you just looked at the stock market broadly, you would think, boring week. But under the hood, there is a massive divergence happening.
It is stark. If we look at the one-month performance blocks, we see a very clear story. The winner, by a significant margin, is the real assets block.
Okay, what's in that block?
That is gold, oil, commodities. They are absolutely crushing it, up nearly 4.7% on the month.
Okay, so physical stuff. Things you can drop on your foot, that is winning. Who is losing?
Digital stuff. The crypto block is the loser, and it is not particularly close.
How bad?
Bitcoin is down 27.5% in a single month.
Wow.
Yeah, it is the worst performing block in the data by a wide margin.
That is exactly. If Bitcoin crashes, usually tech stocks and risky assets follow. But here, Bitcoin is tainting, but real assets are soaring.
Right. This is not a standard risk-on or risk-off environment. The data is describing a real versus digital regime. Investors are fleeing intangible assets and piling into hard assets.
Do we have a number on just how extreme this move into hard assets is? Because gold bugs are always saying to buy gold, but this feels different.
We do have a number. If we look at the Z-scores, which, for our listeners, measure how much of a statistical anomaly a move is, gold has a one-year Z-score of positive 3.04.
Okay, for those who skipped statistics class or, haven't thought about a bell curve in 20 years, what does a 3.04 mean in plain English?
It means it is a 3 sigma event. Statistically, in a normal distribution, this is the most extreme positive anomaly in the entire data set we are looking at.
The most extreme.
Yes. It means gold isn't just drifting up because people like jewelry. It is acting as a safe haven in a way we haven't seen in a long time. It is a violent rotation.
And Bitcoin.
Conversely, Bitcoin has a one-month Z-score of negative 1.59. It is the most extreme negative anomaly.
So, real assets up, digital assets down. That sets the stage perfectly. But now let's talk about the broader economy. Because we got a massive data dump on February 20th that seems to have everyone spooked.
The GDP and inflation prints, this was a classic bad news is bad news release.
Let's run the numbers. GDP came in at plus 1.4%.
Which was a big miss.
Right.
The consensus from economists was looking for nearly 3%. And the data shows that the government shutdown actually shaved off a full percentage point from growth.
Okay, so growth is slowing down materially. Now, normally that means inflation should be cooling off too, right? If people aren't buying stuff, prices drop.
You would hope so. That is the standard economic textbook theory. But the PCE inflation data...
The Personal Consumption Expenditures Index.
Exactly. The one the Fed loves to watch. It came in hot, plus 0.4% month over month.
So we have slowing growth and sticky inflation happening at the exact same time.
There is a word for that.
The dreaded S word.
Stagflationary. It is literally the worst of both worlds.
Now, why does this matter so much to you, the average listener? Why is stagflation such a terrifying word for the market compared to just a normal recession?
Because it creates a double bind for the Federal Reserve. It effectively ties their hands behind their back.
Explain that dynamic.
Well, normally, if growth slows to 1.4%, the Fed would rush in and cut interest rates to stimulate the economy.
The famous Fed put.
Exactly. They swoop in to save the day. But they can't do that right now.
Because inflation is too high.
Precisely. Inflation is still running at 3.0% over the last 12 months. If they cut rates to help growth, they risk sending inflation even higher.
They would be pouring gasoline on the fire.
Right. So they're stuck.
And the market knows it. Which brings us to maybe the weirdest data point in this entire deep dive, the relationship between stocks and bonds.
The correlation structure. This is where the invisible shift is happening, and it is fascinating.
Usually we are told to hold a 60-40 portfolio because stocks and bonds balance each other out.
That's the conventional wisdom.
When one zigs, the other zags, or at least they don't crash together.
That is the theory. And if you look at the last 6 months, the correlation between the S&P 500, the SPY, and long-term Treasuries TLT was basically zero.
Zero.
It was negative 0.003. They completely ignored each other.
Okay, so no relationship. They were strangers. But what happened in the last month?
That correlation dropped to negative 0.90.
Negative 0.90. That is almost a perfect inverse relationship.
It is a massive shift. Stocks and bonds are moving in near perfect opposition right now. Now, we have to be careful with the math here because bond prices move opposite to yields.
Right, bond math is always backward.
Yeah. But in this specific context, the source tells us this inverse correlation is the fingerprint of an inflation scare.
Unpack that. What does that actually look like on a trading desk?
When the market fears inflation, like we just saw with that hot PCE, print interest rates go up, that means bond prices crash.
Okay.
And because higher rates are bad for companies, it makes borrowing much more expensive, stocks crash too. Or, conversely, if rates fall, stocks rally.
So the dominant narrative driving the bus right now is the rate shock.
Precisely. It is not about corporate earnings. It is not about AI innovation right now. It is purely what are interest rates doing.
The rates market is just pushing the equity market around. If rates sneeze, stocks catch a cold.
That is exactly what the correlation matrix is showing us.
Which is a perfect segue to why rates are jumping around. We have to talk about the news. We mentioned the Supreme Court earlier.
Yeah.
This wasn't just a minor administrative ruling. This was about global tariffs. Now, just to be clear for everyone listening, we are not taking a political stance on trade policy here.
Right. We're just looking at what the source material says about the market impact.
Exactly. Impartial analysis. So, what did the court do?
It was a 6-3 ruling, striking down the president's use of IEPA, the International Emergency Economic Powers Act, for global tariffs.
So the court says you can't do that, and the market probably cheered for a second, thinking free trade is back.
For a brief moment, maybe. Investors love certainty, and they generally dislike tariffs because they are inflationary. But the administration immediately pivoted.
On the same day, right?
Yes. February 20, they signed a new order using Section 122 of the Trade Act of 1974.
Lawyer ball. I love it. What does Section 122 do differently?
It allows the tariffs, but it comes with a catch. It implies a 150-day time limit. So the uncertainty didn't disappear, it just changed its legal shape. And now there is this looming question about $175 billion in potential tariff refunds from the previous regime.
Wait, explain that. Refunds?
Well, if the Supreme Court ruled the initial mechanism illegal, importers might be entitled to get their money back. We're talking about $175 billion.
That is a staggering amount of money.
It is. And if the government have to pay that back, where's the money come from?
They have to issue more debt.
Exactly. More debt issuance. Which explains why the bond market is nervous. It adds fiscal uncertainty right on top of the inflation uncertainty.
So you have the government potentially on the hook for billions, while simultaneously fighting a shutdown that slowed the economy down by a full %. It is a mess.
It is a fiscal mess.
And while the lawyers were fighting in Washington, things were getting incredibly hot in the Middle East.
Event number 2 on our deep search, Iran. We had a brief closure of the Strait of Hormuz and the U.S. considering military action.
And we saw the reaction in the oil markets immediately.
We did. Oil, represented by the ticker USO, had a 1-week Z-score of positive 1.09.
Which means...
That was the strongest single-week anomaly in our entire data set, a massive spike.
But here's where it gets really interesting for the stock investor. What happened to the relationship between oil and stocks?
This is critical. Usually, high oil prices act as a tax on the consumer, which is bad for stocks. But this week, the correlation between stocks and oil jumped to positive 0.72.
What was it before?
Used to be much lower, around 0.35.
So stocks and oil are holding hands right now.
They are moving together. Energy stocks are basically propping up the broader index.
Wait, so if the Iran situation calms down, which would be objectively good for the world, good for humanity, and oil prices drop.
Equities might drop too.
Because right now, that war premium in oil is actually supporting the equity market through the energy sector.
Exactly. If that support pillar gets kicked out, stocks could tumble.
It is so counterintuitive. Usually you think lower oil prices are good for the economy, but right now the market is addicted to the energy rally.
That is the complexity of this specific cross-asset regime. The bad news overseas is acting as a strange kind of floor for the S&P 500.
Okay, so let me get this straight. We have a Supreme Court constitutional crisis on tariffs. We have a potential war in Iran, and we have undeniable stagflation.
That's the setup.
If I were betting, I would say the fear gauge, the VIX, must be exploding. It must be at an all-time high. People must be panicking in the streets.
And you would be totally wrong.
I love being wrong. It usually means I'm missing something important in the data. Tell me why.
This is the mystery of the calm.
Yeah.
If we look at the system turbulence score, which is our measure of how crazy the market is acting across the board, it is only at the 31st percentile.
That is shockingly low. That implies things are relatively quiet.
It does. And the reason for that quiet is the credit market. We look at HYG high-yield corporate bonds.
Junk bonds, risky corporate debt.
Right, the canary in the coal mine.
Because if companies are going to start failing, it usually shows up in junk bonds first.
Exactly. And that canary is singing a very happy tune right now. High-yield credit has been in a low-volt regime, a low volatility state for 43 straight weeks.
Almost a year of perfect calm.
And spreads on BBB-rated bonds, investment-grade stuff, are at the 3rd percentile. That is extremely tight.
So the bond market is essentially looking at all this chaos, the Supreme Court, the inflation, the Strait of Hormuz, and saying, we don't see any defaults coming?
Yep. They are saying companies are fine. We're not worried.
The credit anchor is holding firm.
They are looking at corporate balance sheets and seeing total resilience. But...
there's always a but.
There's always a but. The volatility market tells a totally different story. We need to look at the spread between realized volatility and implied volatility.
Okay, let's unpack that, because that sounds like heavy trader jargon. Realized volatility is what actually happened in the past, right?
Yes. Realized volatility using a JRCH model is currently at 12.23.
Which is low.
That is below the median. The market is physically calm. Prices are not swinging wildly day to day.
So the water on the surface is smooth.
The water is smooth. But implied volatility is what traders think will happen in the future. It is the price of options.
It's forecast.
Exactly. Implied volatility, the VIX, is at 19.09. That is above the median.
So there is a gap between the reality and the forecast.
A huge gap.
Yeah.
The spread is 6.86 points. This spread is in the 85th percentile of history.
So let me try an analogy here. It is a beautiful sunny day outside, just a gentle breeze. That is the realized volatility.
Right.
But everyone is running around the neighborhood buying extremely expensive hurricane insurance. That is the implied volatility.
That is the perfect analogy. The market is paying a huge premium for event risk. Yeah. Traders are looking at the tariffs, the Fed, Iran, and they are saying, it is calm right now, but I am terrified of next week.
So we are in this weird state of ghost insurance, paying for a disaster that hasn't actually happened yet.
Yes. Investors are hedging against a crash that the credit markets boldly say isn't coming.
And that leads us to the persistence of these regimes. How long can this waiting game last? Because insurance premiums aren't cheap.
Right. You can't pay expensive insurance premiums forever. Eventually you go broke or the storm actually hits.
Something has to give.
Exactly. And we are seeing signs that the waiting game is getting long in the tooth.
Yeah.
We track regime persistence.
Basically, how long has an asset stayed in a certain mood?
Yes. And the S&P 500, the SPY, has been in a mid-vol regime for 39 weeks.
Is that normal?
No, that is longer than the model expects. It is overdue for a shift.
A shift to calm or a shift to chaos?
We'll look at the long-term bonds TLT. Just last week, TLT flipped into a mid-vol regime with 91% probability.
Oh.
Yeah. The bond market is waking up. It is moving from calm to nervous.
So the foundation is starting to shake just a little bit.
It is. We are in a tense waiting game. The equity market is priced for a disaster, the high VIX spread we talked about, but the credit market absolutely refuses to acknowledge it.
So to summarize the board for you listening, crypto is out, gold is in, the broader economy looks incredibly stagflationary, the courts are fighting the White House over trade, but corporate America's credit score is seemingly perfect.
That is the picture. It is a highly contradictory, incredibly complex environment.
So here is the provocative thought for everyone listening to mull over as we wrap up this deep dive. Who is wrong?
That is the ultimate question. Is it the credit market, which says everything is fine and dandy? Or is it the volatility market, which is bracing for an imminent impact?
Because they can't both be right.
They mathematically cannot. And usually, when the spread between fear the VIX and reality realized volatility gets this wide into the 85th percentile, it resolves quickly.
Meaning
Either the disaster actually happens and realized volatility spikes up to meet the fear, or the fear evaporates, the geopolitical events pass without incident, and the VIX crashes back down to reality.
So we won't be waiting long to find out.
I don't think so. The tension is just too high to hold.
Well, keep your eyes on the data, not just the headlines. Thanks for taking the deep dive with us today.
See you next time.